Well, good morning, good afternoon, or if you're watching this at a later time, good evening. My name is Mynor Ramos. I am a mortgage professional, mortgage banking professional, worked with four large banks. And a fun fact about me is that I attended a high school in the city of Chicago that offered a aviation course because I wanted to be a pilot. Went on, flew a 152 at the age of 17. And then when I went into the Army to try to get recruited, they told me that because I had ankle injuries from a wrestling injury, I was not qualified. Ah, that'll help you remember who I am. But over here, we also have Michael Domico. Michael, please introduce yourself.
Good morning, Minor, and good morning to all who are watching. My name again is Mike Domico. I've been in the insurance business a couple of years, and I have enjoyed a somewhat successful career. Um, Fun fact is I love to travel. Been to Egypt three times now. Also, I'm a dive master, which is the second highest level of scuba diving. And I dove for the New Jersey State Aquarium. I have over about 1,500 bottom hours. And it's one of my favorite things to do is to be, 30, 40 feet underwater, communing with fish.
Well, for the audience, I just want to mention when Mike D'Amico says, I've been in the insurance industry for a couple of years, let me qualify that. So I want, if maybe you're active in the chat, I would say, how many of you have been in the insurance industry for less than a year? And how many of you have been in the insurance industry for less than 5 years? And how many of you have been in the insurance industry for less than 10 years? 20 years? 30 years? 40 years? Let's stop at 50 years. Mike, how many total years have you been in the financial and insurance industry?
This is actually my 52nd year.
So here's the translation to that. He's young at heart. He loves to teach, and he wants to give back to an industry that has done more for him than he's ever given to the industry, according to what he says. But to qualify, what he's bringing to the table is all of these years of experiences, challenges, changes in the industry, and people who are no longer here, that he has the knowledge and the history in his mind about how things used to be. So if you ever have any questions about this industry, Mike D'Amico is the person you want to have in front of you. So with that,
And if I may just add to that, that is my mission at this point in life. I am more than interested in giving back. So if there are any people that have questions or they have problems even with a case, please, I'd be more than happy to help.
but we're getting a little ahead of ourselves because people may not know what a case is, but we will get to it. Let me explain what we're doing here. This is going to be very conversational. Look, we are here to educate, and we're here to give back to something that we find very, very close to our hearts for many reasons. And you'll get to know about that as we go through. Now, there's some engagement points, and this is where I would say, do what we've done to prepare for this. We have alerted everybody that is close to us that would need to get a hold of us in the next 45 minutes to an hour. And we let them know we're going to be busy for this amount of time. We have also silenced all of our devices, and we have cleared our schedule. So this is what I would recommend that you do, is that you are fully engaged. This is going to be better if you view it on a desktop, because there might be some screenshots that you may want to take along the way. But if you do that along with something to write with, oh, this is going to be a good one for you. Now, I don't know what time of the day you're watching this, but Tell you what, this is primary. This is necessary. So coffee is the way for me to get going. So I told you we're gonna have fun. I don't know how serious you are about, look, you're here for a reason and you're gonna get education. But we also don't want this to be like one of those traditional, long, drawn out, this one guy talking out there and on the board. Oh my goodness, this is not that kind of training. So with that in mind, let's get right to it. Let me go ahead and share the slides and we'll get right to it. So here we go. Are you guys ready? Are you guys
Ready?
Are you guys? So building wealth in the new economy, in the new era. We're talking about we're in 2023. Look, let's be clear here. The great financial reset is upon us, has been with us. What did the pandemic teach us? There were things that you weren't told about. There were things that they kept under the rug. There were things that kind of a blindfold. Well, guess what happened with all that time? Many people had a lot of information to learn. And what we're going to talk about today, it's presented to you by none other than Advanced Insurance Services, which is comprised primarily, the individuals, teaching you here. But the reason why it's called advanced is because it's not your traditional type of financial conversation. Now, why is this important? Well, I told you about our experiences, 20 years plus in the mortgage banking business. Then you have Michael Domico, where he's 50 plus years of the insurance. We've helped hundreds of people increase their cash flow, pay off debt, and leave a legacy using a concept that's called infinite banking. Now, if you're writing notes, infinite banking isn't new. The reason why it's new to you is because maybe you've never been told the information. And there is a book by Nelson Nash, who is a person that kind of introduced this idea. Well, here's what happens. There's a book out there. So just because you didn't know that the book exists, oh, by the way, it's not on here either. It's none of these books behind me. Not at all.
I don't even think I have a copy anymore.
But this is an easy system to take control of your finances so you can be your own source of financing and obtain financial freedom. Mike, let everybody know, how exciting is the concept of infinite banking?
For me, it's one of the most interesting and important concepts in our industry. I had the privilege of meeting Nelson many years ago, and he used to run a college out of Atlanta, Georgia. I haven't talked to him in 20 years, so I have no idea what he's up to. But he turned me on to this, and this was one of the things that propelled my career unbelievably, because all of a sudden insurance took a turn for me. It wasn't just a death benefit. It wasn't just for my heirs. It wasn't just to have cash for retirement. It was a tool that I could actually use every single day. Changed the whole industry.
Awesome. Well, here's the thing. We're going to go through a few lessons, 4 lessons to be exact, and we are literally so excited about this. So let's start with lesson number 1. If you're writing down, go ahead and put lesson number 1, and that simply is make money at a lower interest rate than you pay. Now, some of you are throwing your pen on the floor and saying, Mynor, what kind of craziness are we talking about? How can you make money at a lower interest rate than you pay? Well, remember, I told you infinite banking isn't new. So why don't we take a look at what traditionally happens. So let's say, Mike Domico wants to go and buy a car the traditional way. He's going to go to, BMW, Lexus, Toyota, wherever he wants to get his car. And over here on the left, you have a $30,000 auto loan. We're going to look at the future value in just a minute. And you have an annual rate of about 6% for a period of 60 months. So if you do the math on that, you run a calculator, which you look them up on bankrate.com, they're all free. The payment on that is $579.98. Okay, pretty simple. First of all, it's unrealistic because you can't get a new car for $30,000 anymore, not the good ones. It's probably going to be double that. Number two, the interest rate is going to be probably different than that. And number three, most of the terms are 72 months. But let's just keep going here. The future value of that loan, when you take $579.98 and you multiply that times 60 months, the future value is $34,799. Now, if you're writing this down, write down auto loan total $34,799. Now, remember that I told you the first lesson is make money at a lower interest rate than you pay? Well, let me show you what that looks like. Here you have a traditional savings account at $30,000, the same amount that the car is costing you. Now, look at, I am being absolutely gracious because you can't get a bank that'll give you a yield of 4% on your money. It's probably about 0.25%, if that. But let's just say that we're absolutely super generous and somebody is giving you a 4%. At 60 months, if you do the math on that and you run the calculator, the future value of that is $36,630. Now, I didn't say that you had to be a mathematician. I'm not quizzing you. You probably, it's been a while since you've been to school, but let me ask you this question. The traditional banking calculation, is it more than the bank loan for the auto? The answer is yes. $36,630, $34,799. The lesson is make money at a lower interest rate than you pay. Did I just not prove that to you? Well, hold on tight. Mike, go ahead and explain why and the secrets that the banks know that they don't want us to know. Here you go.
Well, and Mynor, you and I have discussed this before, and again, none of this is new, none of it's a secret. But a gentleman, no less than Albert Einstein, once called compound interest the eighth wonder of the world. Now, the problem, it works as much against you, excuse me, as it can work for you. So what's going on in the loan situation? You're borrowing money, you're paying a rate of interest to a bank, and the bank is reinvesting your money into all kinds of other things like credit cards, mortgages, so on and so forth. Whereas when you're at the 4% interest rate, you're earning money and it has nowhere to expand. It's just the 4% on the money that you put in, and therefore you show a little bit higher rate at the end. But in essence, when you start looking at inflation, when you start looking at what you put out for the car, so on and so forth, you are losing money. You're not gaining money at this point. The idea of infinite banking is, how do we turn that around? How do we put that compound interest in your pocket rather than the banks? And that is the essence of what we're talking about.
So what you're saying, Mike, is that when somebody goes to a auto dealership, whether they do it, like the big dealerships, people show up, or they have some of these dealerships that are online, and you just order and everything online. I know the millennials, They love to do that because they can't stand the idea of going into a dealership and battling out, the price of the car, the monthly payment. But what we're saying is that this all happens without your knowledge. So
Yes.
really the concept that we're showing you here, this alone can yield to you the knowledge and the experience that you need to be able to make smart financial decisions when it comes to buying a car. Excuse me. And now you know what the banks aren't telling you. So my suggestion is at this point, go ahead and write down any questions that you might have. I'm going to give you a few seconds here. Write down any questions or maybe even some thoughts that come to your mind. That way, as we go through and during the Q&A, we'll be able to go through that. So let's do that now. So now that we've covered the first concept, which is make money at a lower interest rate than you pay, let's go ahead and dive into lesson number 2. Lesson number 2, become a wealth creator. Now let's talk about this. And I want you to write down in your notes, what type of a concept are you familiar with? Are you the kind that, where you're a debtor, where you're always borrowing money to get what you want? Are you a saver, where you say, you know what, I'm in the school of I never buy anything until I have all the money saved up for it? Or are you a wealth creator, which we're going to explain? So just kind of think in those two terms. There's a few schools of thought. Mike, I don't know about you, but when I was, coming out of high school, one of the concepts that my parents taught me was you don't go and buy anything, especially large ticket, unless you have a sizable amount of money. Really, getting a loan for a car payment really was kind of, during maybe the 70s and 80s was kind of kind of frowned upon. And right in the 80s, some of those interest rates were so astronomical, most people didn't even qualify. But then as the 90s came along and the 2000s came along, it just became the easiest thing for people to do, to get into debt, to buy the car. So the savers were really the ones that were kind of running the show. Then let's take a look at what a debtor looks like. So Mike, if you want to go through this, just explain. I love the way you explain this concept. Go ahead.
Well, unfortunately, my parents tried the same lesson. I didn't pay a whole lot of attention earlier in my life, and I spent a lot of years as a debtor. I'm a lot more cognitive of it now, and I'm transitioning into wealth creation. However, it's not unusual to start with this whole idea of being a debtor. So you see the straight line, which is zero cash, and then below that you see this sort of a inverted step or inverse pyramid, whatever, however you want to phrase it. And this is if you're borrowing money to buy a car, since that's one of the examples we're using. You buy a car, and of course, when you first start out, you put the whole amount down on the car because that's how the cars are paid for, and then you pay it back monthly. And then when you finally get to the point that the car is now 5 years old, you've paid it off. However, you have an asset that's 5 years old and you're back to zero. You've created no wealth, you have no savings, and unfortunately, the car is not even worth what you paid for it. That's just the idea of a commodity. When you call it an asset, it's sort of not 100% correct because it does depreciate. Then all of a sudden you say, well, you know what? That car's 5 years old. I need to get an update on my car. You start all over again. You go to the bank or you go to the car dealer, you finance the next car and put out a large amount of money, which you then pay back on a monthly basis. And when that second car is paid for, another 5 years, we're now 10 years down the road, and you now have a 5-year-old car that's a depreciated asset. The original car you had gotten rid of, and you still have no cash. So you are on the way to the poorhouse, as my parents would have said, because you haven't accomplished anything on the wealth side. So that's pretty much what's demonstrated here. And this is good object lessons of most people's life, especially early, especially when you're younger.
So in that car payment example that we looked at, that at $579, I mean, talk about the bank knowing this. They give you the loan as a promise to pay. It's a hold on your future earning potential, your income. This is why they have to verify your employment, and you have to go through a credit application, and they look at your credit score. So you have to qualify for this. How many people go through this qualifying process, right? To give away their money, which is insanity to me. Drives me crazy. Anyway, on top of that, they're paying some of the highest market rates for the interest that they're paying. So thanks for explaining that. Let's take a look at a saver. And this is the story I was talking about that, years ago, this was kind of the way that people used to do things. So a saver saves money and earns a little bit of interest. Maybe in the 80s it was a little bit higher, maybe 3-4% if you held it in there for a very long time. But look, I mean, I don't see any banks offering 0.25%, 0.5%, 1%. Even if it was 3%, that doesn't even keep up with inflation, right? So okay, so they're earning interest, they pay cash for everything, then they borrow from themselves, right? But then here's what happens. They start at zero, year 1, year 2, year 3, year 4, year 5. They have the 30,000 to go and make that purchase. Wonderful. What happened to their money? It's gone, right? All of their money's gone. And then now, as Mike was explaining, you have an asset that, well, a car really isn't an asset, is a liability. But let's just argue that because they paid for it, they could say that it's an asset. But it's a deteriorating asset because they know that in 5 years they're going to have to replace it. So they start the process all over again, and they do that over and over and over.
But what's important in this example, Mynor, it's the same result when you talk about any type of wealth creation. Right, there you go. Both cases end up in zero after 5 years in that example. So you're not any further along as far as putting something to build for the long range picture. You're on a 5-year plan, and that's as good as it's going to get unless you break the cycle.
And what you're talking about, Mike, is called missing an opportunity cost, which is the hidden things that the bank isn't telling our audience. It's the opportunity that's being missed. So here's a way to look at that. Now this is, and I know I see a term, your eyes are already turning towards this, Mike, the OPM, but let's go ahead and explain this one here.
Well, this is exactly what the bank is doing. Okay, so this shows somebody's wealth curve. They're buying a car, again, to stay with our example, every 5 years, and the wealth that you see in that green line, the upward trend, isn't necessarily in our example the client. That's what the bank is doing with your money. So you're paying the mortgage on that car, and then every 5 years you're buying a new one. But all the interest that's being accumulated is by the bank, who then reinvests it in other loans, credit cards, real estate, whatever. What we are talking about is how do we change our zeros and exchange it for the bank's upward curve.
Right. And in that regard, we really want to look at something that's called uninterrupted interest. So what does uninterrupted interest really look like? I know you're taking notes. I know that you're hearing some concepts that you weren't taught in school. Look, it's not your fault. I had the privilege, my parents worked extremely hard to put us through college. And I went and got my undergrad in human resources. Never heard about any of this stuff. Then I went on to get a master's degree. Never heard any of this. So I'm not against school, but I am against some of the concepts that are being withheld from us that matter in the marketplace. That's really what this is all about. So what does uninterrupted interest really look like, guys? I have a question for you. If you were to double a penny for, listen carefully now, for 31 days, because I think somebody may have asked you this before, and somebody may have asked, what is a penny worth after, in a month? Okay, but they don't specify 31 days. Two, they'll probably say, hey, would you want $100,000 in a, or a penny doubled in 30, in a month? Well, let's take a look at that. A penny doubled in a 31-day uninterrupted period would literally be like this. And you're probably saying, Mynor, you really lost your mind. You really, like, what kind of scam is this? Like, how is this possible? How does this even happen? Well, I'm glad you asked. So glad you asked. Because look, math is incontrovertible. You can't deny it. 1 + 1 = 2. Simple. That's what doubling means. Uninterrupted interest. If you double a penny, the next day is going to be 2. If you double that, it's going to be 4. If you double that, it's going to be 8. And I know this is not a math class. Now, as I walk people through this, I often get people that they're like, okay, Mynor, I get it, 64. They're right around day 14. They start to wonder, you know what? Okay, I believe you. But once we get into this right here, where it starts to getting into some of the, the 4 digits, hey, I don't know if this is true anymore. And I lose them right around here. There's a psychological reason why that happens. Most people have never seen a deposit, that's this in a, in a one-time transaction. Usually it takes a lot of transactions, a lot of accumulation. But when you look at this and you get up to up until day 30, it's $5.3 million. And a lot of people, this is where the answer is usually very common. They're like, oh, it's about $5 million. And it's true. But the reason why I asked you 31 days, because I want you to look at the difference that one day makes in this. So if you just double a 30-day into a 31-day month, look at the difference. 10 million. Mike, what are your thoughts there?
Well, this is obviously the basis for the concept of compounding interest that we talk about. This is the type of thing that the average person never has the opportunity to even learn, as you said, Mynor, let alone try to do it. I've never been able to do it. Why pretend? I wish I could tell you I know how to do it, except I do know how to approach it. So I'm never going to double a penny for 31 days and walk away with 10 million. That's not going to happen. But once you got the idea of the principle, that then brings you into the idea of the wealth creation. And we can talk about that because that is possible and that is attainable by the average person.
So that is the valid question, is that people would ask, well, how are you going to double a penny for 31 days? Well, we're talking about a principle here. The result of interrupting that interest growth, I want you to write this down. It's called a recast period. And a recast period looks like this.
Right.
You were going along and doubling your money. And right around day 22, this could be a 401k account. It could be a mutual fund. It could be the cash value of a life insurance. It could be anything that accumulates and you get the interest on. But on day 22, your air conditioner broke. Transmission went out. Your buddies told you, hey, we're going on a last minute trip to Las Vegas. And so you go into this $20,000 pot and you grab it all. And what do you have to do?
Start
Start
all over.
all over again.
Yeah.
So
I
the
usually do that about the 10th or 11th day.
most people
That's only different.
do.
Yeah.
Most people do. So the idea is that if you understand this part of accumulation, you also have to know the consequences. And this is where people usually fail. And what is attributed to this is literally no discipline, no knowledge, no education, or all three. That's it. Simple, right? So the concept that we want you to learn is you must understand how interest acts, because in the example of the car loan, remember in the first lesson we learned that we're going to make money on a lower interest than we pay, right? Well, look at what happens. Banks know this. Banks know that this is where you don't have any discipline. So they know that this is where they're going to be able to get you. And so they're just going to keep perpetuating that interest accumulation, that they have. So why don't you write down some thoughts about, what you think you've done so far, maybe some questions you might have about the way this works. Write down some things that you would like to see changing, and let's go ahead and write that. So now let's take a look at lesson number 3. And I think about this all the time. Like, there are so many people that are so skeptical. Let's be really clear here. People are skeptical. People are cynical. There's so many things that have happened. But I have a question. What is the best tool for earning compound interest? Now, Mike, let's remind everyone what is compound interest, because we have short memories.
Well, compound interest very simply is as you earn interest on your money, not touching that interest, and hopefully as much as the principal as you can, and then you get interest on interest. And that is the whole compounding effect. That is what creates wealth. Under our present scenario, before we learned about the principles we're talking about, that was always what the bank was doing with our money. What we want to do is now take the principles and do it ourselves. In essence, how do we become our own bank?
Now, can you become your own bank using a traditional everybody talks about real estate, right?
Yeah.
So we have real estate. A 401k is what people have been taught, and there's a whole lesson on 401ks. We won't have the time to get into that. There are people that are now going into crypto. I'm not against it.
Right.
I think that there's a lot of potential there, but I think there's a lot of intrusion as well. I'm just giving my 2 cents worth on that. Where else could people turn, without going into the lesson? Where are people turning for accumulating compound interest? If it's not real estate, like the traditional brokerage accounts, the crypto, where else do they go?
Well, this will be a surprise to everybody, I'm sure, but the absolute best vehicle I've ever found is life insurance. And let me explain that by going back to what you mentioned. The problem with real estate is you have to be able to market it. You have to know how the market is changing almost every day to be able to create wealth just through real estate. If you talk about any other vehicle, even a 401k, you have government intrusion because at some point they're going to tax it. So you need to have a vehicle that has the ability to grow tax-free, can give distribution tax-free, and can continue to earn interest even if you do take principal out. And life insurance is the only vehicle that I know of that does that, And that's not even counting the death benefit and the self-continuation feature, which we call waiver of premium. So life insurance is the answer.
Oh, come on, Mike. I mean, everybody talks about like, like life insurance is a scam. I mean, cash value policies, like, well, I mean, there's so much information out there and so much unfiltered information that, people confuse, themselves over this. So you hear that the life insurance is only for the benefit once a person dies. That's a common misconception. The other
Yes.
misconception is that you can't really use it on yourself while you're alive. The other concept is you're really drawing death to yourself if you get a life insurance policy on yourself. I mean, what other things, it's safety, right? I mean, the money in a bank is safe. It's federally insured, FDIC insured, right? How
Yeah,
does
yeah.
how does
How did that
life
work out
insurance?
with the savings and loan a few years back?
Oh,
Yeah, you're right. They're all things that I hear all the time. But you know what? Here's the bottom line. There are no better investors over the long haul than the people in the insurance industry. I don't care, who wants to argue the point. You can make money on stock. You can certainly make money on bonds. You can certainly make money in mutual funds. But they are still subject to the market. If the market drops, they drop. Life insurance, properly cast, and I'm throwing that in because out of 2,400 insurance companies, there are still a few that I would not let through the door. So stay with the better companies, the ones that the household names. But the fact of the matter is, nobody can invest your money safer and do more things on the single dollar than you can with life insurance
wow.
and create wealth.
So in a life insurance policy, and we're not talking about the traditional term because a lot of people will get confused about that. And we're talking about a properly designed, high usage cash value policy. It is literally out of the reach of the government and of creditors. So I've been hearing this term a lot now. Do you remember the financial crash of 2008? What did the banks get? It was called a what? A bailout,
Bailout, yes.
right?
Yeah.
Now, there is, according to the Dodd-Frank, right, that legislation, according to that, they can't bail out the banks anymore. So what would you think would happen if the banks lose their leveraging ability or they lose their funding ability? Now I know we did promise that this was an advanced class. So when I say funding, there's a lot that goes into it. The only way that a bank can lend out money is their ability to borrow at a lower interest rate and then somehow make that multiply and then be able to lend and lend and lend. But here's the question for you, for anyone that has money in the bank. I'm not doom and gloom. I just want to ask the question because I keep hearing this over and over again. If there was a bailout of the banks in 2008 and they can't do that anymore, what options do the banks have going forward? It's called a bail-in.
Yeah.
Literally, a bail-in
Yeah.
is very similar to what maybe you've seen in other countries, maybe like Venezuela, Italy. There's so many countries that have experienced this where you go to your favorite bank and you have $100,000 and now you hear that there's something going on and you want to take the money out. Well, hold on, can't withdraw that money. There's not enough funds in there, right? Like, there's other things that need to happen. And so the reason why we mention this is even though the concept of the FDIC kind of gives you the feels good to put the money in there because it's safe. I'm bringing up what we're seeing out there, and you want to be able to really know how this works. But let's talk about who else knows about this life insurance cash value. Oh, this is interesting, Mike. I want to ask you this question. Obviously, when we were doing this, President Biden, wasn't in power. So, this we probably need to update this. But here's the basic principle. I know that our country has gone through many, many different changes over the last 3 decades. I'm not here to divide. I'm not here to be on one side or the other. I'm not. I want you to be clear on that. I wholeheartedly believe that, we're all in this together. But here's the question that I have for you. When these guys get up there and start talking bad about each other, and they start going back and forth about how bad this person is and how bad that person is and blah, 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 blah. And the funny thing is that when they sit down and go through their personal financial affairs, what are they doing? They're doing the same things that the banks do. Now, I might be out of line here, and it could be that, some of them might have some relationships with some of these banks, and they give them all these tools. But the question is, if they're supposed to be working for the people, when was the last time anybody in government taught you how to do this? Mike, you've got some interesting stories. You've got some experiences here.
Yeah, I've worked on committees and so on and so forth that talked about how the industry was insurance predominantly, but also in general banking. And I've heard regulators come up with all types of proposals and attack insurance companies, and the way they pay interest, or what we used to call dividends in mutual companies, or interest on stock companies. And bureaucrats come up with all kinds of suggestions on how we ought to tax the insurance companies. But at the same time, the legislatures, like the 6 people that you have on the screen, are buying insurance contracts, so that when it comes to a vote and it comes to the House or to the Senate, the people that are voting on these knock down what the bureaucrats are saying, not because they care whether it affects you and I, but because they don't want to give up the asset they have. And all of these people had large numbers of dollars that were invested in life insurance because they understood the principles. Now, how they got the money, and you can argue party, you can argue, ideas, and that's not what we're here for. But the fact of the matter is, the thread that goes through our government is the people who know are able to create wealth. The people who don't, and you keep mentioning discipline, and you're exactly right, Mynor, but if you don't know, you can be the most disciplined person in the world and you're still not going to create wealth. So it's a combination of knowing how to create it and then the discipline to do what you need to do. And life insurance gives you that opportunity because it's the one instrument that encompasses the whole idea of continuing that interest curve so that you're not constantly bringing it back down to zero.
So you're basically understanding the difference between can and may.
Exactly.
Can is the concept of ability. So you have the knowledge and the power to do so, but the other one is the concept of permission. And now you have the tools to be able to do this, right?
Right.
Very, very interesting. Let's go into this here. I'm curious. Did you know that some companies take out a life insurance policy on employees for the sole benefit of such corporations? And again, I may have lost a few people here. Mynor, don't talk bad about large corporations. They're all good companies, and I'm sure there are. Here is an example of some of these companies. I know the one that stands out the most, which is the one that people talk about, is Walmart. So how does this work? Well, I don't know how it works for Walmart, but I can tell you this. I worked for, I can't say the name, but I did work for a large banking mortgage type company. When I signed the initial information about like, these are going to be your employee forms. One of those forms was permission for this company to open up or to obtain a life insurance in my name, because the concept was I was worth that much to that company that if something happened to me, they would have an interruption of the business because of what the value that I brought in. So I was, I'm sure that we're protecting the six figures they were paying me. But here's the thing. In the description, it said it would be to the benefit of such corporation. Now, Mike, is that fair?
Well, you know, we could argue the point, but you signed it, so you made it fair. Um, uh, it's not fair if, in the sense that it didn't benefit the employee directly, except that you may not have gotten the job if you didn't sign it. One of the examples I like to use, and I've mentioned this to you before, is a country. One of the countries, it's not the richest in the world, but has one of the strongest pension systems in the world, happens to be the United Kingdom. And the reason for that, or one of the reasons it's got such a strong pension, is that every employee that works for the government, no matter what their job is, from working on the railroad to working in an office, has an insurance policy. Now, the one difference between how the UK does it compared to some of these corporations is they actually split it, so that when you get hired by the United Kingdom, whatever the policy is, whatever the face amount is, half of it goes to your beneficiary if you were to die, and then half of it goes to the UK. And that's going to take us into a future course on life settlements and how insurance can actually become an investment. And that, of course, is a life settlement. But for our purposes, what is important is that even countries, as well as the major corporations that you have outlined, do that in one form or the other. It's a way of transferring wealth. It's quite that simple.
So it's so interesting because I know that some of the audience is going to be more familiar with the financial terms, the insurance terms. They might say, well, that sounds a lot like the split dollar, right? Like they don't even use that term anymore. But the idea is that the worth of the employees is far greater than the person that puts their butt in that seat and in front of that computer. Well, again, remember, we talked about this is advanced. There is a way through our relationship with a hedge fund, and this is another topic. But imagine taking this concept, and you might be a small business owner, or you might work with small business owners, or you might have this concept of how do we actually benefit individuals with this concept. So here's the scenario. Imagine that these corporations were able to take out a life insurance policy on their employees and leverage the cash value inside that policy to do banking arbitrage, right? They're borrowing a lower rate, and they're getting the split of what they're getting, and it's a form of a dividend. And you know what? There's a financial, obviously, benefit to the company. But here's the thing. The other way that it's been done traditionally, and everybody tells me Walmart is a big contributor with that, taking policies against their employees. But what if there was a way that this could be done, and then the benefit, the benefit of the death benefit of the policy goes to the individual's family? Now that is something that I think is worth talking about at later on. I think that concept is becoming well known. This is what we do. But I wanted to bring that up because there is a way, and there's a difference in how we want to approach this. Now, let's move over to, where do you think your deposits end up? Now, I'm taken by this because I really like the way that people are so enthusiastic about their banks. They love going to their banks. I mean, when you go around and so if you go to the first of the month is usually a really busy day at the bank. Fridays for some reason is a really busy day. So like for some reason you don't want to go to the bank on a Monday or a Friday or the first or the 15th or the 30th. I don't, those seem to be out there. So what, you know what, I look at that data and I say, well, that sounds like there's a lot of people putting in deposits into the bank. Mike, what do these corporations, big, large banks have in common?
They have lots of money,
How do they
and
get,
and
how
it's
do they
all
get,
yours.
how do they get that money? And where do they put our depositors, their depositors' money? Where do they put it?
Um, they obviously have a lot of avenues, but most of it they're putting back into instruments that are loaned out to clients, you and I, because this is how they constantly have the money in motion. And when you get into the dynamics of money, money in motion is more important than an interest rate, because even if you're earning a lower interest rate on one instrument, as long as it's in motion, you're keeping that earning money all the time. And that's what the average person is never able to do, because the concept is just seems foreign until you understand that it's a lot simpler. And again, this is what infinite banking is all about. How do we take that constant motion of money and use it on an individual level for our own families?
So what you're saying is the movement of money and the velocity of money is where the banks really understand, how to get it going. Now we have done a special training on the 8 banking principles.
Right.
What I hear you say is, when we talk about those banking principles, I mean, there's interest cancellation, interest accumulation. There's a concept of a float and leverage, which is what the banks do. So what you're saying to me is that on any given day, at the end of the business day, the banks will collect all those deposits, wrap them up, shift them offshore so they can, for 12 hours while we sleep, while we go home, get dinner, put the kids to bed, go to bed, wake up, go. By the time that it turns around 12 hours later, the bank has made money on our deposits. Comes back, it starts to work on the other side of the world, and it kind of goes around. So the movement of money. So you're saying that on top of that, on top of the banks already using our deposits for that, and on top of uh, getting the banking arbitrage with our money, the banks are putting large amounts of capital into such instruments that are safer. The reason why is because life insurance contracts have some guarantees and are safer than any other ones.
That's 100% correct. But even let's go back to the velocity of money. I've actually seen diagrams that are very, very simple. They're not complex. You can read them and understand them, showing the motion of $1. You go to the bank and you put in $1 into your savings account that you're earning 0.025 on. That $1, if you followed it through the velocity that the banks create, can earn as much as 25 to 35%. The same dollar that you're only getting a quarter of a point on is earning the banks in excess of 20%.
Sounds like you're talking about fractional banking.
Sounds just like that.
Sounds like it. But let me introduce this idea. You see the lollipops there on the bottom? Most people, when they go to the bank and they have their kids with them, the first thing the banker will offer them, do you want a lollipop? Well, let me tell you the reason why they give you that and what they don't tell you. Mike, you were just explaining the concept of fractional banking, where you take your $1 and by doing that, the bank has now the power to turn it into 10 times more than that. And as you mentioned, even up to 3,500 times more than that, right? Here's what Here's why I think it's so funny. Like in the 80s, I remember this, open up, open up a bank account and get a free toaster. Like,
Yeah, yeah,
okay, and get a free blender. I mean, like crazy stuff. And I always wonder, like, as a young person, I would think about this sometimes. How in the world do banks make money? Like, I mean, all you're doing is I'm taking my money and I'm guarding it. I'm putting in a checking account and say, but I'm still using my money. How do the banks make money? Fractional banking. Now, the reason why I think it is kind of like a subtle thing. Here's a lollipop, you sucker.
yeah,
I know that's harsh. I know some people might take offense to that, but listen, when I go into the bank, I refuse that. I just won't take it. So let's take a look at, and I know that this is something that you really enjoy. Like here it is. Here's let's talk about fractional banking. How does that work?
yeah. Minor, this is the perfect example. So let's go to the bucket on the far left side of the screen, your deposit. Now they're doing 10K. It doesn't matter the number. You do it $1, you do it 10,000. Okay. Now they're saying you put it in the bank, you're getting 4%. They were the good old days. Now you're getting, 1/8 of that. But here's what's important for the audience to understand. The bank doesn't let that money sit in the vault.
Mm.
They turn around and they take that money and they put it on a mortgage for a house at 7%. As that mortgage is paid each month, they then take that same dollar and give it to someone to buy an SUV at 8%, which of course is low. That's paid back on a monthly basis, and so on and so forth. So whether it's for buying a car, remodeling your house, or debt consolidation, that same dollar that you put in and only got a quarter of a point on is constantly making more interest for the bank. That's the whole idea of how fractional banking works. And the average person, number one, doesn't know it, doesn't understand it, and can't believe that they can do the same thing, but they can.
So what you're saying is the $10,000 gets deposited. You might get a quarter of a percent. It might be $1 or $2 of interest at the end of the month. It covers, your, printing your statement, the cost of printing your statement. But what's really interesting is, that mortgage, when that mortgage gets funded, that funding mechanism creates 10 times more than that. So let's just say that somebody was to buy a house for $500,000. Now you can multiply that times 10, and that's how much power you were given. So I talk to people and I tell them, look, the pen that you take to sign the mortgage, deed of trust, all the financial aspects of that mortgage, your signature is worth so much more than the bank itself, because without you, the bank cannot fund that instrument and create further ability to fund other instruments. That is a critical part. And we've gone into some of our trainings, we go into and break down the whole entire concept of an amortization, the fact that you're being taught just to look at the interest rate, the APR, the interest rate, the term, and the monthly payment, because that's all you will be satisfied with, right? But over here, Mike was explaining to us, maybe, it's they're giving you 4%, very gracious if they did that, but then they lend it out. So let's take a look at what it looks like. 3% plus 4% plus 5% plus 8%. You know what? Aggregately, what does that look like? Well, let's do the math. 20 divided by 4 is 5. But when you turn that into a percentage, it's 500%. Mike, I know everybody's thinking there's no way. And like, how do the banks turn 500% on our deposits, right?
Yeah, that's a slow month. They're actually doing more than that. and you promised to have some fun, so let's have some fun.
Yeah.
There's a movie that explains this so much better, and a great star by the name of Jimmy Stewart. If you haven't seen the movie, let's forget the aspect that it's sort of a Christmas movie, and that's It's a Wonderful Life. There's a scene in there where there's a run on the bank. And I want to make 2 points with that scene about the run on the bank. First of all, he's explaining to the depositors that he doesn't have the money in the bank, because when Mrs. Jones deposited her money, he loaned it out to Mr. Smith to buy his house.
Mhm.
And that's a perfect example of what we're talking about with fractional banking. But there's another aspect, and that's Mr. Potter, who's the villain of the whole place, who happens to have all this money, more than most people ever accumulate. He turns around when the savings and loan is in trouble and tries to buy it for 50 cents on the dollar. So this is the principle of 2 things about banking. Number one, the fractional banking, and what does it actually mean? Money comes in and it's loaned out. It never just sits. And second of all, how people who have wealth create more wealth. They take advantage of the run on the bank, take advantage of a bad economy, because when everybody's selling because they have to, just to subsistence, just to live, people that have capital are buying. Some of the largest, wealthiest families were created out of the Depression because they were buying when everybody else had to sell.
Interesting.
So
And
that's what wealth creation does.
but before you get to wealth creation, you have to understand the 3 levels of finance. Number 1 level of finance is that rat race that everybody's kept in, like trading time for money, living paycheck to paycheck. And I don't know that we can say paycheck to paycheck anymore. I think it's direct deposit to direct deposit, right?
Yeah, right.
But the second level of finance is, you understand that in order for you to create wealth, your money has to have babies. That's what I like. I like, the level 2 finance. And then level 3 finance, you're talking about wealth creating wealth, right? So let's talk about that. How does someone take the concept of what the banks do with fractional banking and begin to institute that in our own economy? Well, this looks familiar,
Yeah.
but there's something here that's a little different. How does this work, Mike?
Well, it's exactly how the banks do it. It's taking the same principle, and whether you are buying a house, a car, remodeling, or debt consolidation, why pay those interest rates that are 500% above what you are earning to the bank? Keep them in your own deposit, your own account. And life insurance is the tool that we are going to use to do that. So that as you're paying those premiums into the life insurance, you then borrow out the money from your own policy to do anything in life that you want to do and pay yourself back, so that the 500% becomes the return on your money rather than a 4% that you deposited in the bank.
Wow. So let me pause here for a minute. I want our listeners to go ahead and take some time to write down their thoughts, maybe some questions, because I know that we've thrown a lot at them. Now, Mike, you and I have become very comfortable with this topic. We lost the fear of the unknown, and that's the only reason why we're so incredibly comfortable with this. Is like, like second nature to us. But to some people, I understand it's probably too much. Go ahead and take some time and write down anything that may have struck your mind. That there was a lot at this point. So let's go ahead and write those down. Write down some questions before we go into the next lesson. So now that you've had some time to write your thoughts about the lessons that we've covered, we really want to dive into lesson number 4. And this was a fun one, guys. I think this is so much fun because it's not something that, again, you get to hear much. And this lesson is literally how you can make money from every car purchase. Man, those are nice Camrys, though. Actually, when you look at that, I kind of like the blue one. Which one do you like, Mike?
Well, I don't know. I like them all. My problem is mine are never clean.
Listen, I'm a car guy. I love them, but you know, we're not here to talk about cars because the concept that we're going to talk about is the vehicle because it's the easiest one to explain. The reason why most people are visual. But I want you to think about this and I want you to write this down. If you're a business owner, think about as we go through this how you can implement this into your practice, whether it's buying equipment, buying inventory, controlling your payroll, maybe even you're a real estate investor. Oh my goodness, talk about that. How about if you stop the madness of going to get these Harmony loans or bridge loans and you start to create your own wealth and maybe taking the the arbitrage, or maybe you're a mortgage professional where you begin to understand the rules of lending, but maybe you could become your own lender. I mean, we're talking about becoming your own banker. Why not become your own lender?
Mynor, you in just a few words have said so much there that I sort of want to go back, only because it's the average person is going to miss so much. And that is simply this. In infinite banking, becoming your own banker or your own lender, however you want to phrase it, you have now touched on wealth creation at the pinnacle of what it can do. Because no matter who your client is, and now I'm talking to the professionals in the audience, you're going to sit down with some guy who has a landscaping business. So he's not so much interested in buying a car because he's got to worry about going out and buying, $5,000 mower to keep his business going. And he's got to go to a bank and borrow that. But if he can turn around and borrow it from himself and then multiply that by paying it back and paying himself a rate of interest, and this is true for any business you want to get into. And Nelson Nash always used the example of the car because that was the one that most people could relate to. But what you said, Mynor, is that any businessman who decides to be their own banker can create wealth without making 1 cent more than what he would make without understanding wealth creation.
That's wonderful. And even though we have doctors and attorneys and engineers. I mean, look at the different spectrum. It doesn't mean that those are the only people that could qualify for this. The qualification is what's in your head. You start where you're at and you make adjustments along the way. So we don't want people who feel like this is beyond them.
Right.
We don't want to lead them down the wrong path. But what you're saying then, Mike, is we talked about the concept of fractional banking. Now we're going to talk about how we can use this idea of fractional banking within our own economies, not necessarily changing it. And I hate the word budget. I like to rephrase it with cash flow.
Right.
And I know that there's a big guru out there that teaches about budgeting. I understand. I have a lot of respect, but I do think that that's for level 1 thinkers, level 1 finance. We need to get into the level 2 and level 3 finance. This is what this is all about. And I mentioned the doctors because they have a high level of education, but sometimes we need to simplify it. So why don't we go ahead and take a look at look at this example of how you can become your own banker. And again, all the principles apply to any of this. Mike, take us through. This is a vehicle purchase of $25,000. Now, there's a lot of things going on here, and this is your world. Let's go ahead and take everyone through the explanation.
Well, so you're as you said, you're buying a vehicle for $20,000 and you're making your car payments. So in the first couple of years, it looks like there's not a whole lot of money accumulating, but it then starts accumulating because you're paying interest on it. The bank is doing whatever the bank does with it. What we're going to look at is if you're making that purchase and you're making it out of your account, in this case, a life insurance policy, how does that work? Well, it works exactly the same. So if you went to the bank and borrowed it, I think on your diagram, you're using an 8%. So let's stay with 8%. You're paying the bank 8% to borrow that money as you buy the car and you pay it back. If you buy it from yourself and you come up with the 20,000, 25,000, whatever it is, you pay it back with the same diligence that you would have paid the bank. And this is critical. This is where the discipline comes in. You just don't put it in your pocket and then call that wealth creation. You put it back into your insurance policy, but you also put it back with interest. So you may like yourself better than the banker likes you. So instead of charging yourself 8% interest like the bank did, you're going to say, I'm going to put it back into my policy at 5%. So again, the calculators are free. You can find them on many places on the internet. You figure out what it would be. You borrowed 25,000 from yourself. You're going to pay it back at 5%, even simple interest. And I'll explain why it can be simple interest rather than add-on or compound. And you pay it back to your insurance policy. As you do that, your insurance policy is now replenished, the money you put in. It continues to grow. But here's one of the secrets about insurance, and this is why insurance is so powerful. On most of the modern contracts, and I'm referring specifically to ULs and IULs, and for the people that don't understand that terminology, universal life or indexed universal life are the two products I'm referring to. As you put that money back in, the interest that the insurance company is paying on your principal amount of money is the same. Let me dissect that a little bit, because there's a lot in there when I say it's the same. Let's say you had $30,000 in your IUL and you borrowed out $20,000 to buy a vehicle, and you paid that $20,000 back on a 60-month note like you did with the bank, only you gave it to yourself, you paid it at 5% interest. You would say at the end of the day, you paid yourself 5% on 20,000. However, the part that you are not going to be aware of, and why this turns into a compound interest situation, is that while you're paying that back, the interest on your principal isn't interest on the $10,000 that's remaining. Remember, you had 30,000, you took 20 out, so 10 is there. The interest that insurance policy is paying you is on the whole $30,000. So as you pay back that 20, you have the interest on the 30 going in, you have 5% interest on the 20 that you borrowed going in now. At the end of the day, whatever your interest would have been with that insurance policy had you not taken out the money is increased by 5% on the 20. Now that money is in your bucket, so to speak, of your cash value. That's now earning interest. And that is the definition of compound interest, interest on interest. Now, if you were to do this multiple times, we're talking about doing it one time. If you were to do this multiple times, what you then find out is that somewhere around the fourth and fifth car is absolutely free. And why is that?
Yeah, we're going to get to that part. And
okay.
So you said a lot, and I just want to bring people, some people are like their heads are spinning right now. And come back here for a second. Let's dive into this a little bit more. So here you have day one, year one, and some of you maybe just got your life insurance license and you think you know it all. I love that. It's exciting. Some of you have your own practices. Some of you have your own agencies. Some of you have a lot of clients that have not had this, explained before. So let me dive into this a little bit more. There's no such thing as this. This isn't going to happen overnight without any kind of an effort. So in year one, there's a deposit of $10,000. Now this deposit could come from many different ways. I think that we've talked about some 401k conversions without the penalties and all that stuff, and we dive deeper into this. But I want you to look at year one, $10,000 deposit. Now I want you to look at this. This is really interesting because this is your private fund And there's at the end of the year, there's around 60% of that $10,000 that's available for you to be able to borrow. The reason why I mentioned that is one of the biggest, well, there's a lot of gurus out there that don't like this concept because they don't understand it. They say that it's too expensive. But if it's properly designed, they'll tell you that it takes you way too many years, 10 years, to get to this 60%, around the 60% of cash value. But we're showing you here that within the first year, you're going to be able to do that because you properly designing it so that it can work for you as your private bank. But let me ask you one question. If you had $10,000 in the bank right now and you weren't getting this kind of a return, you weren't able to borrow this much with leverage, how much is that $10,000 worth? It's just 10,000 plus maybe a 1/4%. You see this over here, the death benefit? This is what makes it so powerful. Out of that 10,000, day one, the value of a collateralized, write that word down, collateralizing this purchase of this vehicle. Now your car purchase is 25,000. Your death benefit is 680,983. That means that you turned $10,000 into potentially $680,000 should something crazy happen. I'm talking about you're in a hospital bed or something happened to you and now you're leaving. Now your family is collateralizing getting out of that debt, that $25,000 debt, because the $680,000 will pay that off. But Mike, I like the way that you explain this. What happens if maybe I don't know, somebody takes this out and they get into some kind of illness?
Well, again, this is why a properly orchestrated insurance contract is so valuable. So yeah, the death is easy. If someone were to die, there's $680,000 for his heirs. But what happens if there's something worse than death? What happens if there's a disability? Well, there's different types of disability. So let's just sort of, put them in one big lump. First of all, you're not going to be putting any more money into that contract, very possibly for years. There's a feature in life insurance called self-completing or waiver of premium, waiver of cost. Different companies call it different things, which simply says after 6 months at paying those premiums, once you've been disabled, the company's going to return that 6 months premium to you. And there are no further premiums until your personal doctor says you can go back to work. Now, there's no bank, there's no stock fund, there's no bond fund in the world that does that. That's one of the powers of the life insurance other than just dying. Another one that's only about 15 years old, I didn't have it for most of my career, but I now have it, and that's what's called living benefits. Again, there's something worse than death, and that is contemplation of death or contemplation of terminal illness and of resources that are needed by the family to maintain, doctors, hospitals, whatever. Well, with living benefits, you can now actually tap into that 680 of death benefit, pay for some of those bills. The balance would still be paid at a death benefit as you were to pass, but you're not accumulating debt for your family while you're ill. So this is a lot more than just getting a cash return on your money. Now, if you're one of the lucky ones and you dodge the waiver bullet and never have to worry about disability or a living benefit and live to a ripe old age, then all that cash accumulation and the paying back of those loans every time you borrow it out, then you reap the benefit of those. There is no instrument in the world like life insurance. And we're not even going to get to the piece de resistance in this conversation. That is, if you do live to a ripe old age, how do I take that money out and spend it tax-free? That's another story for another day.
Right. So before we go into the next, I just want to point out that there is a discipline factor here. There's $10,000 going in, but there's also the discipline of repaying those car payments out of that $25,000 purchase. You putting that back into And remember, every time you pay the interest, you're paying yourself the interest. Now, I am a little bit on the analytical side, and I know there's a lot of analytical people here. So after 7 years, you would have put in $100,000, but there's 67,881 in cash value. So what we're saying here is, as the years go by, this cash value principal becomes larger, and then of course, in order to keep it from becoming a taxable event, the the death benefit of the life insurance keeps increasing to keep it from going into what's called a MEC, or modified endowment contract. Now, there are some rules, because we want to set people up for success. There are some rules that have to take place. And that number one rule is to pay yourself first. Now, I know that you've heard this before, but maybe there are a lot of people that have parents that have tried to teach them this before. Now, my kids, they have this concept that's called a parent voice. Like when your parent tells you something over and over again, and then they're like, okay, whatever, they're not listening. But then somebody else like Mike Domico comes along and they say, hey, listen, there's this concept, pay yourself first. It's the best thing you can do. And they're like, Mom, Dad, I met this guy named Mike Domico, and he told me that the number one rule that I have to understand about finance is that I got to pay myself first. And I'm kicking myself in the back saying, where did I go wrong? Mike, why is paying yourself first so important?
Well, when I first started in the business, I had a manager that was one of my mentors, and he says, you pay the banker, you pay the baker, you pay all the different utility bills, you pay everybody, and then at the end of the day, you have nothing for you. If you pay yourself first, you're going to be able to create something. And I want to also slight turn to the right here a little bit. For the newer agents, for the guys and gals just starting out in the industry, they're sitting there going, you know what? If I ever found a client that had $10,000 laying around, I think it would be in heaven. Yeah, you're right. Yeah, you're not going to find that as a new agent very often anyway. But here's the thing that you want to keep in mind, and this is something my father told me many years ago. He says the only difference between the millionaire and the working guy is the number of zeros. If you have people, translate that into sales, if you have people that you start out on a program, they're not going to have something that they're going to be able to borrow money out of quickly, because the first couple of years of an insurance policy, as even this illustration shows, there's not 100% cash available. It takes a while to build it up. But if you never start, then you never have it. So for the new agents, don't be discouraged that you're not going to necessarily have somebody that has big number of dollars to dump into insurance policy. Start out with the $25 a month plan, the $50 a month plan, the $100 a month plan. They still in our industry talk about that the average client who you build and you take care of is going to buy from you 7 times in their lifetime. So what we're talking about now may be a target, and the agent knows about it and tells us to the client that if you're paying yourself first and you started off on this policy for $25,000 to make sure your family can bury you, that's the beginning. That's not the end of the process. But this goes back to what we talked to in the beginning. Discipline comes in after you have the knowledge of what to do. So again, for the new agent, tell your client, here's what you can do. I just had a recent conversation with one of my agents, and I said, look, he wanted to talk about putting large sums of money in with this new client. I said, stop. You're going to scare the living daylights out of this guy. Start him off with something that he understands. Show him how he accumulates some cash. And in 2 or 3 years, he can now go into the next step, which in this case was infinite banking. Now you're doing a proper job, okay? This should not be a burden on your clients paying a premium.
And
Because Mynor and I talk about larger numbers, don't confuse that with, well, I can't do that. Yes, you can, but start out at the level that you're doing the best job for your client today and let them know how you can improve that going forward.
So when we talk about day one and paying yourself first, I mean, these are some scenarios that we're putting out there. But as Mike was saying, look, it doesn't have to be exactly the same thing for every one of your clients. One of the things that you want to consider is a person's biggest wealth right now is their health and their youth. When we talk about life insurance is cheaper when you're younger and when you're healthy. So, that $25 a month, I mean, it could literally be a term policy that covers them for $500,000 that then later could be converted into a cash value.
Right.
Like, we're giving you some nuggets here. So
Right.
Paying yourself first is important. But what else is important? Paying yourself the interest is the number one rule. That's not the number two rule that we want to talk about. And the way I like to explain this is control the contract that pays you the interest. So you've tried this before with regular banking. You don't control the contract. They tell you how much. Okay, we try. Why don't you try this? Why don't you go to the bank and tell them, I want you to give me, and then you go ahead and explain all of this to them. They're going to look at you like you're crazy. So the way to do it is, if you want to become your own banker, control the contract where the interest is held. That contract is the life insurance portion of the cash value. Any thoughts on that, Mike?
Yeah, and I'm gonna do a flashback to one of your earlier screenshots where you showed buying the car every 5 years and the green line, which continued to create wealth. That's what Mynor's referring to right now. So if you can stop and think what we're doing here, you're putting money into an insurance policy, you're building a cash fund, you're borrowing it out, whether it's for a business to buy a car, piece of equipment, new office equipment for a young doctor, whatever you're using the money for. But by constantly paying yourself back and paying yourself interest, you now created that green line that we showed in the original chart. The money that was originally going to the bank, creating wealth for them, is what you're now creating for yourself. But the discipline of putting the money back, as well as the discipline of paying yourself interest, are now critical, so that you're not just spending your money as you go along and then you're back to where you were before. Okay, so creating wealth is the ability to put that interest in there. It's constantly making more money. You're constantly building more than what your income looks like you're able to do. That's the multiplier that we're talking about.
And the multiplier looks like getting back to that line, and we call that recapturing. So recapture the interest, and remember, we're talking about the money doing this. It's got velocity, it's got movement, it's got the aspect of a cycle. The smart bankers know that stale money stinks. If the money just sits around, it literally stinks, right? So when you move it around, let's talk about this 91 cents of every dollar that is earned back. And you're seeing here the purchase of the $25,000 vehicle, but with the cash value aspect and the interest going back in, you're serving that purpose of fractional banking. Now, some of these concepts you already know about, but Mike, how do we wrap this idea of, you have the three rules of paying yourself first, paying yourself interest, and then recapturing it, so that now it becomes a wholesome idea for you to now consider how you're going to pay for your cars in the future?
Well, again, it's the knowledge how to do it, which is what we're giving you, the basics, the discipline of paying yourself back, and the discipline of paying yourself interest. And as that continues to grow, the insurance companies continue to pay their return on your investment. And you have the protection of both the life insurance, the waiver of premium or self-completion feature, as well as the living benefits. You've done this through all one instrument that we call life insurance. Now, we keep saying one instrument. This could be 5 different policies. This is the aggregate of your insurance portfolio. Again, the idea that a client is going to buy over 7 or 8 times in their lifetime. This is not trying to do it all at once. And you can do it this way. You can do it all at once, but that's going to be, one out of 100 clients that you'll have in your life. So you want to understand the concept. This is a goal to get to, not necessarily on the first contract that you sell a client.
Gotcha. All right. Well, that's awesome. So now let's take a pause here for a minute. And before we go into this large idea, this grand idea of you purchasing a vehicle and making money on it, go ahead and write down some thoughts, maybe some questions about what you've learned so far, and we're gonna go ahead and go into the next portion. So now, Mike, some of our audience might be just as excited as this guy here. Look at the way he's reacting to that new car purchase. I love it. It's the idea of how many vehicle purchases you have in your lifetime. Many of us will go through maybe 10 or more. Some people like to change cars every couple of years. There's many ways of doing it. But what we want to talk about is this. I still get so excited about this guy. Look at him. He's got some great energy. I don't think we ever actually see people like that in the dealerships, though. I mean, nobody really acts that crazy.
Oh, I don't know about that, but okay.
Let's talk about when you set this up, and after you've gone through the first car, because now we have on the 8th year, you're buying the second car, and then you have the third car here at year 13. How does this keep growing, and you're earning back fractions on your dollars? Like here, you earned $104.14 earned back, but then later on in life it became bigger. Like the pot gets a little bigger, and then we're familiar with that graph of not being the debtor or the saver, but being the wealth creator. So let's go through this one, Mike, and give us your thoughts.
Okay. Well, the thing that I want to instill in everybody's mind, okay, the numbers are real, and they're certainly very pertinent to the whole idea of creating wealth. But I want to dwell a little bit more on the diagram, because this is truly the nut. This is truly the kernel. Okay, so we look at that diagram at the lower part of your screen, and you see that green line that keeps going up. Okay, that's increasing wealth. Now below that, you see taking the money out and paying it back. Only instead of to the bank, you're doing that to yourself. You're taking the money out of your insurance contract and paying it back every 5 years with interest, and that green line continues to grow. So what's happening is your money that you're putting back replaces the principal. The interest that you're paying yourself is what creates that green line, because the insurance contract is paying you interest on top of that the whole time on the whole amount. So when you look at the numbers and you see that every time you bought a car, you paid it back, and your cash value continues to grow, whether you call it the cash value, which is what the insurance companies call it, or if you call it your personal fund, which is one of the nomenclatures that Mynor has used, it's all the same thing. It's all your money. The main thing, you have to pay it back, you have to pay interest, and you recapture the cost by always continuing the loan, pay back to yourself. You never say, oh, I don't have to pay it back this month because it's me. No, you've got to be as diligent to you as you are to a bank. That's how you do it. That's how eventually when you look at the numbers, and we'll be looking at that next, we actually net enough money that you could have had a car for free. You won't see it that way because you're still going to be taking it out and still earning that money. The velocity is always there, just like the bank uses velocity and you never see it. Here you're doing it for yourself.
And then the only caveat to that is that because life insurance has some flexibility to it, not that we encourage it, but should there be something like a really big emergency, we already talked about, the waiver of premium, and we also talked about the fact that there are some things that you can do. So it's not like you have this scheduled payment that you have to pay it on the 1st or on the 15th of the month. It's that you now have to treat yourself the way that you've always treated the lending institutions. If you didn't pay them, they'd come after you. So think about it for yourself. If you don't pay yourself, come after yourself. Now,
before you go on, Mynor, there's interesting. I have had people that have taken this to an end result where they were literally putting their whole paycheck into life insurance. Now, I don't say that as something that you should run out and try to do, but when you get the right person who's analytical enough and they understand this concept, stop and think for a second. If you were to put your whole paycheck into life insurance and paid all your bills with either a credit card or whatever instrument you used, and paid that credit card off every 20, 30 days, whatever it is, before there was any interest, and you paid yourself interest, what would happen to the compound effect that we're talking about? Again, that's not for everybody. It may be in 1 out of 100 cases of this type of infinite banking. But the concept is real. The concept is genuine. We use it on buying vehicles. We use it on buying equipment for a business. But it's good for any consumerism that your client would have to take money out of his pocket or her pocket to pay.
And the precursor to that is called velocity banking, and it's the same concept. Everything that you just explained, being able to pay off a monthly debt through your own checking or savings account. In this example, let's take a look at on the left side. So you went through 7 years of depositing $10,000. You pay yourself first, and you have $70,000. Now on the for 10 years you actually paid $6,000 of car payments, right, for that amount of time. So your total capital investment is $370,000.
Right.
Now, remember we said that you can make money by doing a car purchase, and a lot of people didn't believe you, Mike, when you mentioned that. But over here on the right side, you have roughly $25,000 per year for 10 years. So your expense to get the car was $250,000. So you put in $370,000 and you spent $250,000. The difference between those two is the $120,000. Now, remember we talked about recapturing interest? Remember we talked about how prove it to me. Well, Mike, there's the proof right there. Yep. Go ahead and go through and explain that part, because most of them right now are still pretty skeptical.
Yeah, and it's good if you listen to someone like Mynor, myself, and aren't critical or at least a little bit skeptical, then you didn't hear anything we said, because none of this is what you learned in grade school or high school or even college. This is all stuff, like Mynor has said many times, they forgot to tell you. But that net cost of $120,000 is real money. This is money that you accumulated. This goes, again, back to the diagram with the green line. This is what produced the green line. You recaptured all that interest on all that money that could have gone to a bank but went back to you, and that's what created the net cost of $120,000.
Wow. And in the back, there was still some things that were working themselves out as the cash value increased, the death benefit also increased. And
Yep.
so here, here's an example of maybe somebody ending up at the, ripe age of 85 years old and taking that $1.3 million in the cash value, turning it into something that is going to, give them perpetual income, right? Like it's a monthly or quarterly or annual income for the rest of their lives. And then something happens to them and they leave this planet. There's a legacy that could be left, with the remainder of that, which is, really how we want to make sure that people understand the impact of what you did yesterday, what you're doing today, or you could be doing today, and how the future is going to look. And so when you take those three concepts, you begin to formulate in your mind that you're now taking control. You know what one of the most powerful things is to be able to understand your relationship with money. Most people are fearful and they react to their money. Their money tells them what to do. They can't control where they go to a dinner somewhere, where they go on vacations, what type of house they're going to buy, because their money tells them what to do, and their relationship with money is like a bad relationship. It's the money actually controls them. But you know how powerful and how gratifying it is when you know how to control the things that produce wealth. Isn't that why we're here anyway? To learn how to produce the wealth. And if you're an agent, if you're an insurance agent, the more problems you solve financially for your client base, the more it's going to produce for you. And I'm not talking about commissions, guys. I'm talking about that inner feeling of knowing that you provided for them a solution that they didn't know about. And the more problems you solve, the more your wealth grows. And then the more you're able to make some kind of an impact. So I want you to start to think of now, with all these principles and the 4 lessons that we've covered, what will you do differently? How can you take this and run with it? How can you internalize it, learn it for yourself? Of course, Mike already said you're probably not going to be able to do this on your own. There'll be a lot of questions that clients will ask that you may not know about. Maybe you're a client that's listening to this that really you've gone through the cycle of finance level 1, finance level 2, and now you're in the level 3 finance, and you understand all these concepts. You want to start doing this for yourself, but write down some notes, write down some questions, so that we can get all of those answered for you guys.
Okay. Mynor, thank you for that. As you were speaking, I sat here thinking, and I'd like to say something to all the professionals out there, all the insurance agents, whether you've been in the business 6 months or 2 years, whatever. This is not just a sales concept. This is not just something that you need to go out and try to sell somebody. How about if you take it home for yourself? I buy office equipment all the time. And if you're just starting the business, believe me, that's one of the banes of our existence. You'll be buying computers, adding machines, copiers. I had a copier die last night. I got to go out and buy another one today. What if you have your own bank account, i.e., your personal insurance policy? And the next time you buy that computer, the next time you buy that printer, you don't take out a credit card. Or if you take out a credit card, you pay for that printer or that computer. And before that credit card is even back to you, you borrow the money out of your life insurance policy, pay that off, and then pay yourself back. Start simple. Start with numbers that you can comprehend. So the next time you're sitting across from a business guy and you're talking about infinite banking and how he can buy a piece of equipment for his business out of his own pocket, because it's his insurance contract and not have to go to a bank for a loan, you've already done it. Start with yourself. If you understand the principles and you do it yourself, believe me, you'll find the clients that you'll do it for, because that's what you will see. You did it yourself. You experienced it. Doesn't have to be a car. It could be a computer. It could be a printer. Start small.
Gotcha. Well, thanks, Mike. And we really want to sort of recap, what we've discussed, because we've gone through a lot of material, and we're passionate about this. We love this stuff. We can talk about this all day long, but we do want to simplify it and just kind of take it back to where what we've looked at. What have we talked about? We talked about making money at a lower interest rate than you pay. We showed you the traditional way that somebody pays for a loan, and the traditional way that a bank, will give you the interest, and we showed you the difference between that. We also talked about this idea of you being a debtor, a saver, or a wealth creator. Hopefully, Mike has done such a great job of getting your mind to renew your thoughts, to think more like a wealth creator. And I think that line where everybody ends up at the same, instead of taking advantage of the upside, hopefully that resonated with you. Then we did talk about what is the best tool for earning compound interest, and what banks do with your money and your deposits, how they invest into insurance companies, how insurance companies, and I want to even add to this that and then Mike, I know you've got a lot of knowledge on this part. So here's what I would say. Banks with fractional banking, they take your dollar and make it into 10. An insurance company is the reverse. What they do is their number one thing is to protect capital, protecting capital. So in order for them to do that at a very, very premature or very elementary idea, for every dollar they insure, they have $2 in reserves. Now, I'm just keeping it very, very simple. Now, I know, Mike, there's a lot that goes into life insurance. As there are some agents here, but anything you want to throw in when it comes to how the contract or the inside factors of the life insurance impact this idea of compounding interest.
Well, I think one of the best examples is a term that the average person never hears. As a matter of fact, most agents never heard, and it's called 100% mortality. Very simply, okay, insurance companies, and I'm talking about the top 20, maybe 30 insurance companies, have achieved 100% mortality, which is just a statistical number which says if you had to pay out a death claim on 100% of your client, would you have any assets left? Well, the top 25 or 30 companies have achieved that. That money is exactly what we're talking about. The ability to take a client's premium dollar, buy life insurance, and pay out a claim and still have money left over is what we're talking about, creating wealth. Out of nothing, they created money. You can do the same for yourself.
Imagine, so I know that you and I have had this conversation a lot, is this concept of reinsuring, right?
Yes.
So first of all, an insurance company will have all these, I call them aggregators, they're actuaries, where all they literally do is study, everything that you talked about. How do they get into a position where they never lose money on their capital? But then you got your insurers, how does that work?
Well, it's simply the insurance company that you write a policy on with one of your clients goes to a reinsurer and lays off the risk. So if you had a $100,000 policy, most companies won't keep more than 10-15% of it. So when there's a death claim, you get a check from Prudential to bring to your client, but in actuality, that money came as much as 85% from a reinsurer, which is just an insurance company for insurance companies. And by doing that, they pay a small percentage of the premium that your client paid you they think they're paying at Prudential. Prudential turns around, takes a small percentage of that and buys reinsurance to cover their liability. So it is a chain of events. It's just not you hand it to Prudential and they sit on it.
No kidding.
Money is constantly moving.
No kidding, a chain of events. So again, we love this concept, and we breathe it, and we're passionate about it. But when we're talking about life insurance is the best tool for compounding interest, I want our listeners to think about this. What do you think happens to a mortgage the moment that it gets funded? You get an alert, hey, your mortgage may be sold. And guess what? By the time before you even make the first payment, it is sold.
Right.
It is in an instrument called mortgage-backed securities. And guess what do you think? What do you think the securitization of those mortgages, when they wrap up all these mortgages and then put them into the primary or secondary markets for investing? Well, they end up in, the banks put these together so the insurance companies can run them so they could get higher returns.
Yep.
Isn't that interesting?
Yep.
And so the last concept that we talked about was we showed you mathematically, conceptually, and visually how you can make money from every car purchase. So now you have no excuse. And we also said this could be for a traditional family, where, mom, dad, work, and, they have the kids and they have the house and all that stuff, and they could use it in their economy. But you could be an entrepreneur that understands, how to turn money into wealth, and then wealth creating wealth. Maybe your real estate, title, any concept like that, or maybe even a small business owner. You have a restaurant, and you want to be able to run this, and so you can use this concept for just about everything. Now, I know, Mike, you've looked at so many of these cases. I wonder if there's any one particular, not necessarily the name or because we always want to protect our clients, but any other areas where you can see not just purchasing the vehicle, but anywhere else where you've seen this take place.
Yeah, Mynor, I'd like to just tell a little story. And this actually started with my father. My father was an agent for 34 years before he retired. And that's where I learned, the basics of the business. But back in 1964, 65, he walked into a small store run by two brothers. And he talked to him about a buy-sell agreement. And back then, $50,000 was a pretty large policy. So he wrote two $50,000 policies on these two brothers. Nobody could foresee it because we don't have crystal balls, but 18 months later, one of the brothers died. That $50,000 saved that business from destruction financially, went on to turn into an extremely lucrative business with some very valuable real estate. It's now in the third generation of the family. And unfortunately, but this is what we're all about, the wife of the surviving brother just passed away in November, and I'm right now delivering a check for $1 million. So not only was it generational for the client, it was even generational for the agents, my dad and I. So this is what our industry is about. Infinite banking is a tool. It's a concept. You got to get up, you got to get out, you got to tell the story. You do that every day, you'll benefit your clients and you'll benefit your own family too.
Right. Well, thanks for sharing that story. It's it really is interesting that we don't want to put people out there in situations that don't benefit them, and including the agents. And the agents are in front of the clients. They're the ones that are creating those relationships. But what you just shared right now is how you can stop being a transactional agent and have people inviting you to their barbecues and birthday parties and anniversaries. Now, that's when you know that you've made an impact, when the clients think of you that highly, because you know what we're talking about here is perpetuity. And we also talk about posterity for future generations. you demonstrated that with your father being in the industry and you carrying it on, but the relationships that your father built, you delivering the benefit of what they actually signed up for.
Yeah.
It's some
Yeah.
there's nothing
Like,
more
like
powerful.
I love to refer to it. It's the promise.
Mhm.
That's all we do. We
Yeah.
sell a promise. And, you know, you can be an insurance agent and you can be in the business, or you can have the business in you.
Mhm.
And when you get to see, like this one family we've been with, between my father and I, we've been with them over 40 years. When you see the promise create wealth for your client, and it created wealth for my family also, for my dad and now for me. This is what the promise is all about. But you got to do the business every single day. You got to do your due diligence, like the people that are with us in the course right now. And you got to go out and tell the story.
Wonderful. And so those were the four major lessons. There were some cautions, some golden rules that we did discuss. If you do nothing, if you do nothing at all, like you don't engage with us, you don't put these things into practice, if you just write this down and pay yourself first, pay yourself interest and control the contract that pays the interest, and then recapture and rinse and repeat. If you could just keep doing that, you would have gotten so much out of this training. Well, I'd like to thank Mike Domico because really the 50 plus years of being in the insurance industry and an incredible track record. I get to ride along with Mike, and I get to hear all the lessons, all the stories, all the impact. And I want to thank you for your time. I've been in mortgage banking for over 20 years. Some of the larger banks, which be HSBC, Wells Fargo, Keller Mortgage. I really am. I'm a nerd, fanatic about financial structures and principles, and I can talk about this all day long. I'd like to thank Miami Lakes for one of the events that I was able to speak at. I am a public speaker. I'm an impact partner, but here's what I want to know: how do we do? How do we do? Now I know that you want to put in the chat, or you want to let us know. Maybe you want to follow up with maybe when you contact us, let us know what was one of the things that impacted you the most. What were some of the things that you didn't like? Look, like I'd like to think that we're perfect. That you know what? There are some times that we have to like just humanize ourselves and realize that we're not always perfect. I know that my voice resonates with a lot of people, and some people don't. I get that. I'm not going to take offense to it. Mike, hey, he's like, he's been in front of so many people. He understands the human nature part of it. It doesn't bother us. If there's something that you want us to do better, let us know. If you liked something and then something resonated with you, let us know what we could do more of. I want to thank you for spending time with Advanced Insurance Services, where we really, take legacy planning into another level. My agency, the Throne of Champions Agency, where I have a YouTube channel called The Matters of Eternity, and I talk about the impact of how our family is overcoming the loss of our 25-year-old daughter. The impact that I get out of this is to tell her story. And so I have a segment, it's called Lattes and Legacies, and that goes out every Monday, and it goes into YouTube, but it also goes into LinkedIn. So we are so thankful that you decided to spend this time with us. We know that the concepts that we talk about, you're not going to get on the first try. Making a connection with someone who's gone down this path before is the best way to learn. And here's what I do know. If you were given another course, you're not going to do it. Unfortunately, right now, you're competing with the fact that everyone wants to entertain you. And even though we try to be entertaining, we know that this, if you got another book or another course, you're just not going to do the work. You're not going to implement, the principles that we talked about. So sometimes what you need is a coach. Sometimes what you need is someone who's going to remind you that, hey, there's a few steps that you need to take. So this is what it's all about. Yeah, there's going to be some more information about how to get involved, how to get, how to get in touch with us, and how to make sure that you start implementing this. Remember, we talked about the new economy. The new economy is you have all the knowledge and it's available to you. Now, how do you implement it? That's really the next economy. And I think the biggest economy that a lot of agents have is your relationship capital, the relationships you're building, with some of your client base. I think that a lot of this I like to share is there's an impact economy. This is where I think Mike and I converged, where we started to realize there is a segment of the population who will never hear what we shared. There's also the concept of teaching the next generation about how to implement these things. So remember, we said infinite banking isn't new, but the idea is new to the person who listens to and hears it about it the first time. Now, our commitment is to have an impact in training younger agents the right way so they can stop living and dying with every transaction, and they can stop being jaded by what happens in the industry, and also making an impact in the industry so that we could elevate the conversations. When people talk about life insurance, it is an honorable, a noble way to create wealth. I have so many stories, including our own, of how insurance and the industry has impacted our family. So, Mike, do us a favor, give us your final words of wisdom, and then we'll close it out.
Well, my final words of wisdom are quite simple. Mynor, thank you. Thank you for what you're providing for me, an outlet to reach people, for agents, a place where they can learn and study, and for clients. So the next time one of our agents is in front of a client, they're there for the benefit of that client. In the long run, they will benefit themselves much, much more than the agents that are short-sighted and are just looking out for themselves. Again, Mynor, thank you for what you provide.
Thank you, Mike, and thank you, everyone. We'll be in touch. Thanks for watching.